Have you ever been pitched an annuity as the safe, guaranteed, no-risk solution for retirement income? Then this episode's for you. Stay tuned.
Welcome to a Wiser Retirement Podcast, where we cut through the noise and bring you real, honest conversations about investing, retirement, and building lasting wealth. No sales pitches, no gimmicks, just everything your financial advisor won't tell you.
Welcome to a Wiser Retirement Podcast. I'm Casey Smith. Today I'm joined with financial advisor Michaela Dowdy. I'm sorry, I mispronounced your name. Superstar Michaela Dowdy. Superstar Michaela Dowdy. People still lined up. Her calendar's full.
Your calendar's full too. We're all full.
Yeah.
Like honestly, every calendar's full around here right now.
We're here to discuss, is there a better alternative to an annuity? Don't forget to subscribe to the podcast wherever you're listening. Let's get started. So here's my thoughts on annuities. Okay. Bear with me for a second. Made some notes, my own notes outside the episode notes here.
Oh, goodness. We'll see where this takes us.
So I was thinking, I love history. So I was thinking back in time that I feel like the annuity world is a lot like medieval Europe. Okay. So this would be roughly 500 to 1500 AD.
Okay.
And in medieval Europe at the time, the Catholic Church controlled most things, including education. And education was only for the clergy, not for the peasants.
Yeah.
And I feel that's exactly how annuities are structured, where annuities...
I was wondering where you were going with this.
Annuities are only understood by those that create these annuities. And the peasants, the people who they were sold to, because annuities are never bought, they're sold.
Correct. Yeah, very true.
So the annuities that are sold to these peasants, we are not to be told how these things work for real.
Yeah.
And so I lived in this world, and the clergy would come and they would talk to us about how great these annuities are. And let me tell you, people, the conversation was not about you. The conversation was about how much commission we could get by selling this annuity.
Yes.
It was, and the people, I remember I was right out of college. I was sitting in the room, and I look at all these gray haired guys look like me now. And they would go, how much do I get for this one? How much do I get for that one? How much do I get for this one? There is not one point that anybody ever said, well, what is great for the client? It was, how can I sell these things and get my commission? And that's the world of annuities.
Which is very unfortunate.
They look upon, because you look at the demographic that buy these, a lot of single older women.
Yeah.
Widows. They don't know. They just trust Johnny. They know Johnny from church, and Johnny seems like a really nice guy, and he's a good man. He has a beautiful wife and two young children, and he's just a really nice guy. He wouldn't do anything to harm me.
Yeah. And
Johnny's not clergy. Johnny's like,
no, that's what I was about to say. I was like, there is that middle ground. I was like, because I don't even know sometimes the salesperson fully understands what's happening behind the curtain.
I guarantee you they don't fully understand behind the curtain.
It's just more so, this would answer all of your fears that you just said to me. You said the key phrases I needed to know. And here it is. And this answers all of it. And so it's perfect.
Johnny's not clergy, but he knows the clergy. The clergy has come and visited him and told him that you can sell this product. We'll give you 7% commission, maybe 10 if you sell enough.
Yeah.
And these are the talking points. These will get people really excited about it.
Yeah.
Yeah. So Johnny makes a ton of money, and the clergy makes a ton of money, and the peasants are just as broke as when they came in to begin with.
Unfortunately, that is exactly how that runs.
That's how we'll start. And I'm going to get some emails about that, because people say, I bought an annuity and it was great for me. This happens every episode. I attack annuities. Let me tell you, first of all, we've all bought the used car that ended up being a hunk of junk, and we feel like we're taken. Nobody wants to be a victim.
Yeah.
But chances are you're probably a victim.
Yeah.
Now, there is an annuity that we'll give an exclusion for. And that's the fixed annuity. So let's talk about that for a second.
Yeah.
The fixed annuity.
So your fixed annuity is more so that annuity that you're giving, I would almost kind of compare it to like a CD in some ways. Not exactly. It's a little bit different. Gone. Your money will be locked up for a period of time.
Well, no, it's just gone. Well, no, because in the fixed annuity, it's not an index annuity, but it's a fixed annuity where you're just given $200,000 to the insurance company. They're going to pay you $200 a month for life, but when you're gone, that money's theirs.
Yeah, but you could also, if the fixed annuity, if you're still in your surrender, you can still get it out. If you're still alive, if you don't annuitize the policy, you still have access to
I'm
it.
assuming that you annuitize
That's what I
the
was
policy.
thinking.
I know. You're way smarter than I am. You were already that there was a way out. I was like, no, there's doom and gloom. Your money's gone forever. Yes, I would assume that if you were buying a fixed annuity, you would be annuitizing it. No, you may not. In that case, what are you doing?
They're just trying to get the return and have the security of it, which is not ideal. No, I don't think in any regard.
Then in your point, go buy a CD.
Yes, exactly. Case, that's what I'm thinking of it as more of like you're locking it away for a set period of time. You can't receive it. Granted, a CD, you can get out of it pretty easily, but still.
Right. All right. So if you purchase a fixed annuity, I'll give you a pass because maybe you just want that guaranteed income and you want to subsidize Social Security and you're just going to live on that and not worry about markets or anything else.
Yeah.
Okay. You buy that from your bank. The commission on that should be pretty low. You don't even need to buy it from a bank. There's companies that just only sell fixed annuities. But the ones that are terrible are the variable annuities and the indexed annuities.
Yes.
And those are the ones that when we see them, we try to rescue them. In fact, we have an annuity rescue program. We use Nationwide for it.
Yeah.
It's a flat fee annuity. It doesn't have any guarantees to it. We strip all that stuff out and we just try to get you back into the Vanguard index funds. But the only reason why we have to do that is because there's significant tax consequences to getting rid of it. If you have an IRA annuity, you can just roll that into an IRA and invest as you should have to begin with. But the variable annuity, the index annuity, those are the ones that we all want to focus on today. So, Michaela, why don't you kind of explain? Well, first of all, I should stick to my notes. We don't sell annuities. We don't receive any commission for any products, for that matter. We don't believe that most people need them, and we believe that there's a better way, which we'll get to here as we progress through the episode.
Exactly.
So why don't you explain to us the index annuity and how that's, well, let's start with a simpler one. Variable annuity. How is that structured?
Yeah, so it's more so that the variable annuity is giving you access to the broader market as far as you're getting the ability to, of course, participate in the market returns. However, the, really stipulation to that is that, of course, there's going to be some sort of cap on your returns at the end of the day. And so that's why we really don't love these policies, is because there is typically some sort of cap that you're going to have
in the index annuity.
Yes, in the index that you're going to be facing as far as, okay, well, you're going to invest in this product, and this product is, then going to give you these sorts of options that you're going to have as an option. And if you were to invest in the S&P 500, which makes you feel like you're still investing in the market, then with that, when you get into that, you're actually going to see that there's going to be different, structures to how you can receive your returns. Some of those are point to point on, an annual basis. Some are on a monthly basis even. I mean, I've even seen annuities where, it was reviewed on a monthly basis. And so with that, their returns for the year ended up being 0 when the S&P 500 was actually up, I think it was like almost 20% that year.
Yeah.
And we were trying to really figure out, okay, how did this get marketed this way? And how are they saying it's the S&P 500 when there's this cap and everything? And once we really got down into the details of that product, it ended up being that it was viewed on a month-to-month basis. But what they didn't fully tell you, besides in the fine print, was if the market was down for any month, the full percentage of those losses counted towards your maximum gain you could have each month, which the maximum gain you could have each month was like 1% to 2%. And so if the market was down 10% in 1 month, well, now you've just lost 10 months of any gain. So you were never actually going to have a return.
Even the market was up what during that time period?
20%.
So the market was up 20%.
Mhm.
The annuity gave you 0.
0. Exactly. So there's like even just looking at this finer print where maybe you're not being taken advantage of in the fee side of things, which typically you are as well with, variable and all of that as well. But it is something that there is even, opportunities you don't even realize like, oh, well, I don't have this great commission charge or this other thing that I'm having to pay for, or, these riders are really small fees that I'm willing to pay for. Okay, that's great. But have you actually looked at the fine print of when I'm invested, what are any returns? Because you have to keep up with inflation with that as well.
Yeah. That's my biggest issue with index annuity is they give you the upside, but protect you from the downside. And that really they protect you from the upside and the downside is what happens. The variable annuity is a little different in that it is structured, I would say a little more simply. You're putting money into an account. They are charging you a mortality expense for the life insurance portion, admin fees, probably some other fees. And then your money is going into, they look like mutual funds. They can't call them that because they're so expensive. They call them separate managed accounts.
Yeah.
So your money goes into the separate managed accounts and it will grow. It will track the market. But the problem is that it's doing it in a very inefficient manner and that you have all this insurance expense being pulled out of your account values. Some people say, oh, it's great for tax deferral. And I'll get a little more advanced here for a second. Annuity is the worst thing you can pass to the next generation. That is taxes income. There's no step up in basis. So if you are accumulating wealth, the last thing you want to do is try to save taxes by putting money into a variable annuity. I would argue you could be more tax efficient just putting it into tax efficient ETFs inside a portfolio and do active tax loss harvesting and market volatility. It comes back to how I started the episode, education. If we can educate you on how these things work, not just annuities, but what the alternative is, then you're going to be able to keep a lot more money in your pocket. And but you also have to have good behavior. You have to keep your head about you when in times of turmoil.
Definitely.
So it's some people say annuities are good for longevity protection. I would argue a fixed annuity would help you do that. I don't know that a variable annuity or index annuity, I would argue the index annuity is probably opposite of that in your example.
Yeah.
Because if the market was up 20%, inflation was up a lot that year too. So if your value is basically 0, you actually lost money because of purchasing power, right?
Exactly. And so I think that's where it really does, annuities so much do like speak to and kind of what we were talking about earlier, those key phrases that you can say to like an annuity salesperson as far as, well, I just need protection. I need to guarantee that my, income's going to be here and that I'm going to be able to have, the principal still here, whatever that may be. And so just making sure and having those kind of guarantees is really what, the annuity kind of speaks to. But it doesn't necessarily offer that, full understanding of, okay, well, you might be able to protect in some way, shape, or form this principal or this income rider that you've purchased. But there's also so much more outside of that that isn't being protected because of that as well.
Yeah, that's how they sell them. I mean, the market's really volatile now. Politics are crazy. These presidents and these Congress people, they're going to just take away your money. And then so you go, oh, yeah, you're right. I need some type of a guarantee.
Yeah.
You also guarantee that when you drive your car out of the driveway that you're going to get hit. It doesn't mean that you walk everywhere.
Yeah.
Right.
Exactly.
You take educated, you make educated decisions on where you want to take the risk. In our case, in investing volatility, where do I take the volatility so that I can keep up with inflation? When a gallon of milk is $30 a gallon in a few years, I want to make sure that I can afford it.
Definitely.
And therefore, you have to take on some portfolio volatility. I saw an article recently. It said volatility is the cost of returns.
Yeah, it was very true.
Returns are not free. It seems like they're free because, oh my gosh, I made 20% last year. But the volatility was we're down at 10% at one point.
Yeah.
Right. So with volatility comes returns over time, certainly.
Exactly.
So let's just lock this up as far as why we don't like these things. 2 to 4% internal cost is pretty common.
Mm-hmm.
You can add these riders. That's like,
That's another percent, typically 0.5%.
yeah, it's like going when you're buying it. It sounds great. It's like going to
Mhm.
get ice cream and
Yeah.
they're putting sprinkles on and gummies and chocolate, and
Mhm.
then you get home and do you're like, why am I fat?
Yeah.
Right.
They do have a lot of different riders you can purchase with these that makes them definitely a lot more appetizing and wanting to purchase. I've seen some that are like, they have like the critical care associated with them, or, just saying that you could pull from this money if you just like, not if you decided, but if you, had an unfortunate health event, which is great. Granted, the fact that you're having to pay an additional rider fee to get access to your own money in that instance is a bit, concerning in and of itself, but definitely something that there are just opportunities, or like a guaranteed minimum death benefit rider. I've seen that as well. So it basically just makes it like very much a life insurance policy at that point too. So definitely different opportunities out there. But I think the biggest one that we've kind of seen is really surrender charges, especially, during that 7 to 10 year lockup period that you see with most annuities. Of course, now there are annuities you can buy for 3 years, 5 years. You can get shorter terms on them, but still, typically you're seeing 7 to 10. And I feel like a lot of our middle-aged clients, have these, and I think it is very much like a widow situation, something to that effect, where it was just a taken advantage of situation. And, 7 to 10 year lockup periods can be pretty devastating on funds like that. And so I just find it interesting, a lot of times with annuities, it is something where it's like, oh, this is risk free. You're going to guarantee your principal, you're going to guarantee this sort of a return, or, you're going to have this, performance or this income or whatever it may be as they're guaranteeing with it. And it's more of that risk-free reward in a way.
Yeah.
But what I find fascinating with that is that you actually have it to where you're just taking another risk, because at the end of the day, you're just replacing the risk of the market for the risk that you're not going to need this money for 7 to 10 years.
Yeah.
In a reality, in a lump sum, that nothing drastically is going to happen. And I'm not trying to be fearful either, but, it is something to say that this is very highly a potential that it does, have this surrender charge. And, those surrender fees, like I've seen some that it's a 12% at year 10.
I think they, typically start at like 14. They don't drop until halfway through.
Yeah. So I've seen them start dropping about 7, like year 7 on a, And
halfway
so,
through.
Yeah. And so then it just keeps dropping at that point. And then, and typically it's at the end of your, you have to complete out that last year. So it really ends up being, if it's a 10-year annuity, sometimes it can even look like 11 actually, when you get down into it, because of when it actually ends for those surrender fees.
Yeah. So you're limiting your access to principal. They're also very complex.
Yes.
The index annuity formula, as you just described, every one I have to look at, it seems to be a little different.
Yes, they are.
And it takes a deep search to figure it out, because it's not sitting there on the statement.
Yeah. Well, I think it's funny, like, you're looking at something complex when every single product out there has a fast fact sheet.
That's right.
Like, if you have to Google fast fact sheet for this annuity at this company purchased at this date,
right.
You're looking at a very complex thing at that point, if someone's having to go through and actually gather everything to be in a readable 3 to 5 page format, know? And then even at that point, if you were to pull up the full documents, most of these, have many, many pages of rules and regulations, the different things that they have. And you can really dive into what those formulas are. But again, they vary depending on every single contract. It's not easy across the board to understand.
And the people selling these products typically haven't done any comprehensive financial planning for you. They don't know what's good for you in the end. They may have an idea of your investments and what your objective is, but it's like going down to the Ford dealership and telling them that you need a car. They're not going to sit there and go, you know what? I think this Toyota might be a better fit for you. You should go across the street. No, they're going to put you in whatever product is suitable for you that's on the lot.
Yeah, exactly.
And they're going to, if you want white, they're going to convince you that this blue car is the best for you.
Definitely.
So that's exactly how that world works in the suitability era. Now there are some fiduciary advisors that do still sell these products. I don't know why. I think that they're stuck to the commission. personally.
Yeah.
The revenue, they come from the old world. They created their own firm. They're a little entrepreneuristic maybe, but it doesn't make sense to me. And I think it creates a conflict of interest. However, they are supposed to maintain that fiduciary standard throughout the relationship. So they're supposed to pick what's best for you. And if they tell you to go across the street to Toyota,
Correct.
In that case, but is that happening? I don't know. Is it even policed?
Yeah.
I don't even know if it's policed, to tell you the truth.
I think you have to be able to state why you thought it was suitable if they ever do question it.
Yeah.
I think you can get pushed on it at that point if they were to like file
Right.
a complaint and say, I don't think this was a suitable investment.
That's a
then
whole
technically,
that's another whole thing. You ever
provide that?
You ever get on an airplane and had a terrible experience? Have you?
Yeah.
You have. All right. So you want to file a complaint. You know how hard that is to file a complaint? Multiply that times 10. That's how hard it is to file a complaint on an advisor that sold you an annuity. So if you see complaints on an advisor's record, it was a lot of work to get that there. A lot of work. Again, I feel like that these are products that get sold, not purchased. Inflation risk. These things aren't. Inflation riders can cost you more, but typically these contracts are going to help you keep up with your purchasing power. So you have to be careful. I think we touched on that already.
Yeah. Just to add to that, I will say like that's another thing where you get into those income riders and you're getting this guaranteed income, but you do have to think through the fact, okay, I am guaranteed $28,000 for the rest of my life. Okay, that's amazing. However, 25 years from now, that $28,000 is going to go a lot less far, or not near as far as it is going to go today.
Absolutely.
And so that's just something to consider, because I feel like that's not a topic that's often considered during, the sales process of these products. And just making sure that, of course, maybe you're not purchasing that inflation rider, but if you're looking at a, guaranteed income benefit, then you need to be considering that. Before we get back into the episode, have you ever wondered why annuities keep coming up as a recommended investment? While they're often pitched as a way to reduce risk and secure your future, annuities frequently benefit the salesperson more than the investor. Download our free guide, Buyer Beware, Why Do They Keep Trying to Sell You That Annuity, at wiserinvestor.com/guides. Now let's get back to the episode.
Okay. The clergy has been fired. Everyone in the land will now be educated.
Amazing.
Be able to make their own decisions. Okay. So let's do some education here. What are we really worried about when we buy an annuity? We buy it because we have fear of something. We have fear of the stock market. We look at the stock market. We don't understand it. We think it's a gambling machine. It can be a gambling machine. You can open a Robinhood account and gamify this thing all you want to, but
buy all the penny stocks.
for most of us, this is not. It's not that case at all. So there are different things that you can do or need to understand. Let's start with what we need to understand first. Is that the stock market in a year's time could be up 60%. It could be down 60%. It can be very volatile over a 12-month period.
Yeah.
Over a 3-month period, you pretty much cut that in half. It could be up 30 over 3 years. It could be down 30 over 3 years.
Yeah.
You get to 5 years, you cut that in half again, probably around 15 up, 15 down. You get out to 10 years, the worst thing that's ever really happened is break even. You get out to 20 years, the worst thing that's ever happened is probably an average 5% rate of return per year.
Yeah.
So what that is telling us is that time solves all of our problems. Time will erase our fears.
Yeah.
So then you have to worry about, okay, what do I do in the short term? So knowing that markets are efficient, companies that make money win, we have to have rational behavior. We have to kind of mix something together on our own. And this is what we would call our own annuity at this point. We can create our own annuity, but we need a recipe for this. The recipe is low cost index funds. You got to drive your cost down below 0.1%. You need tax efficiency. It needs to be designed to last no matter what happens in the short term or long term in the markets. And you need diversification across the globe. And you need some cash.
Yeah.
Right?
Exactly.
So academic research, risk management, market pricing, these are, risk management, academic research tell us that we can do this.
Mm-hmm.
Market pricing, where we enter the market, doesn't really matter. So if the market's at all-time highs, then you'll still be successful with this approach.
Exactly.
If it's at lows, then you'll be really successful with this approach. But let's focus on like a 3 to 5% withdrawal framework. So if we're going to take out somewhere between 3 and 5% annually, here's what I would do. I would picture 3 buckets. You have 3 red Home Depot buckets.
Mm-hmm.
1, 2, 3. In the first bucket, you can put anywhere from 2 to 5 years of your withdrawals. So whatever you need to withdraw money from. So if you're going to pull out $20,000 a year, just using an easy number, then you'd have either $40,000 or $100,000 in there, depending on how much security you want to build in. That cash bucket today can earn probably 3.5%, maybe 4%. So it's not just sitting there idle; it's earning something, and that's where your monthly payment comes from every single month. The next bucket is going to be about 40% of the account value, not counting the cash, and that's going to be sitting in bonds, mostly short-term U.S. Treasuries, things that are guaranteed. In a low yield environment, you might have to go into high quality corporates. You might want to add a little bit of foreign bonds like BNDX from Vanguard in there to be able to get some foreign exposure. Hedge, basically you're hedging the dollar. If the dollar goes up a lot in value, that hurts the bonds. Yeah. So BNDX helps you to hedge that. So you have a small percentage of that. So that's about 40% between that bond fund and then you're in that second bucket, and then your first bucket, you probably have 8 to 10 years of reserve.
Yeah, typically.
Worst thing that's ever happened. Worst thing that's ever happened. Actually benefited bonds.
Yeah. Yeah.
Right? Your bonds are probably up 4 or 5%. You have now protected yourself from the worst thing that's ever happened with bonds and cash.
Exactly.
60% needs to go into something like the S&P 500 index fund. Diversify that a little bit. Add a little bit of foreign. Add a little bit of small cap. You could add a little bit of technology if you wanted to. Sector ETF. That 60%, I would say you probably would never need that your entire life. Depending on how much money we're talking about going into that account. That 60% is going to earn what the market earns, and in the really good years, your 60% might turn into 65 or 70% of the total of the last 2 buckets. And when that happens, you take your gains and you put it back into the second bucket, the bond bucket. We've basically created what the insurance companies are doing with your money, except they're keeping all the gains. And in your example, they gave you 0.
Yeah.
They got 20%.
They got 20%. You got nothing.
A goose egg.
Yeah.
That's an extreme example. I haven't seen that one personally, but I have seen very low returns of index annuities where they cap you out at 3, 4, 5% per year. Market did 20. And your same thing. It's what you get on the monthly basis.
It
right?
is.
So I'll give you some more education. I posted this on my LinkedIn page and on X recently. The stock market actually has bigger moves at nighttime than it does during the daytime.
Interesting.
So if you're going to try to time the market because you're scared of what Mr. Trump's going to do with your portfolio or what Mr. Biden might do with your portfolio, insert name a politician here.
Yes.
I'll give you a real quick tip. It doesn't matter. It doesn't matter who's in office. There's no correlation between your portfolio and who the president is. No correlation. There are daily movements related to what they may say or do. Yes. But in the end, we don't live off of our daily portfolio movements. We live off the year, right? And
exactly.
There's very little correlation. We just need companies to make money. If Mr. Trump is in office, or he is in office, Mr. Trump's in office and none of the companies made money, the market's going to be 0, even if he said all the right things that you agreed with.
Yep.
If Coca-Cola doesn't sell syrup, if Delta doesn't sell seats,
Yeah.
stock market goes to zero, right?
It's a very Atlanta
what
choices. I love that.
No matter
funny.
what the president of the United
Yep.
States says, right?
Yep.
If he says all the wrong things, according to you, and Delta sells seats and everything else, you're still going to make money.
Exactly.
We had one client out of hundreds that insisted on sitting out in the first Trump administration. And he sat out. He lost so much money. In the second administration, he was like, I don't like this guy, but I'm in. Just put me all in this time.
Yeah, I'm not making the same mistake twice.
Yes. And I had a heart for him. Most people would not be able to stay here if you're dictating when we're in or out of the market. But so think about this. When the market closes, and I have this graph in my head, and I maybe we can add the link to my LinkedIn on this podcast show notes so people can see that. But when the market closes at night, the rest of the world's still open, right?
Yeah.
When we come to work, they're kind of going to sleep, so their markets are shut down. So there's a lot of things that are still happening in the world. When if you look at the market open and market close, it doesn't open where it closed the day prior. A lot of times it might open 500 points higher, 500 points lower, right?
Yeah.
Those differences at nighttime and the opens are often greater than the daytime and what happens in the daytime. So if you decide to sit out of the stock market, you're missing out on most of your returns.
Yeah.
Now, this will be solved in probably 3 or 4 years because New York Stock Exchange says that they're going to move everything to blockchain. And once they move everything to the blockchain, then they'll have to have 24-hour trading. So Michaela has volunteered to do night shift.
Yeah, that's it. That's me. You'll call it 2 a.m. and I'll be here.
Right. So yeah, there'll probably be some interns for that hour. Maybe.
Yeah.
I don't know.
The late night concerns.
So the whole point here is that we have, as humans, we get these biases that we think, if we think about something long enough, it becomes factual. And that's what a lot of people do. And that's how they end up in annuities because of this market stuff. Just because you don't understand something doesn't mean it's bad. It just means that maybe you should take a little time. Read A Random Walk Down Wall Street. Yeah. Great book. That's a great book to understand how markets work and what you should be doing. A lot of our investment philosophy comes from A Random Walk. So you can create this portfolio, which is a lot of what we do here. You can create a portfolio like this, and you don't have to use 40 bonds, 60 stocks. You could use 30 bonds, 70 stocks. You can do the opposite. You could use 60 bonds, 40 stocks. There's so many different ways you can mix it. But the important thing is that you have that cash reserve set up. If you're still working, you have a paycheck, it's called your emergency reserve fund. Yeah. When you're retired, it's called a cash bucket. And that cash bucket is separate from your emergency reserve. And that is what allows you to keep taking a monthly distribution, no matter what happens in the market, no matter what chaos is happening. You don't have to participate in that.
Yeah. Well, and I feel like that's why too, like so many of our clients, when the market is, going down or, there are these more volatile swings, we're not getting as many phone calls as you would think. It's not that, oh, there's all, a lot of, concern and anxiety and that sort of thing. It really is more so, okay, for our retirees that are taking money, they still know they're going to receive their, quote unquote retirement paycheck each month. And that's because we have, established this cash bucket philosophy. And even if the market's going to be down for a couple years or something to that effect, we're going to make sure we're, raising cash at optimal times to replenish that bucket. But then also, they can rest assured that they're still going to be okay on the other side. And I think it's because of this sort of education and because of the fact that, this is established and they have effectively created their own insurance policy on their investments.
Yeah. I mean, there's no guarantees. There's no
Correct.
in this approach. But I would argue that the only way I see stocks and bonds going to zero, I would argue that your insurance product's probably not guaranteed either, because that means the U.S. government has collapsed. Seriously.
Yeah.
I mean, the U.S. government backs these insurance policies, but if the government's not there, like what are you going to do?
Yeah.
You're going to stay in line like everybody else. You're not going to have any liquidity. So
Exactly.
if you want to have a doomsday portfolio, that's a whole different podcast. But I think for most sensible people,
Mhm.
it just doesn't make sense to buy these
Mhm.
annuities. They're high commission, which you pay for that. You pay for it by locking your money up.
Yeah.
Higher fees. Um, you know, fear-based sell tactics. So there's a better way.
Yeah.
And this is something that any fiduciary financial advisor would be able to model out
Mhm.
and say, no, don't buy the annuity. This is our process instead.
Yeah.
And they start with, we have a cash bucket, then you're in the
Mhm.
right place.
Yeah. Exactly. I will say that I do think something too, and I think we've kind of touched on this a little bit, is like, if you are someone that's listening to this and you're like, well, what happens if I've already purchased the annuity?
Yeah.
It is something that, of course, like we do this day in, day out of, I feel like I've had a lot of annuities lately that we've done analysis of, just to see. And, I've even had, a client that stayed in the annuity and is actually going to, pull income from it in the future simply because she's already, paid into it for so many years.
She's 20 years down the
And
road.
she's 20 years. Yeah. And,
Right.
she's a very risk averse individual. And also she doesn't have any children that this money is going to be left to necessarily. And so it just makes the most sense for her at this time to say, okay, let's use this for the income benefit once you retire. And, you've already paid in for this benefit. Let's utilize it to your advantage. Because at the end of the day, sure, we could pull it all out, without a surrender. But then at the same time, this income benefit does look great and it has a nice little inflation associated with it. She did purchase that. And so it's just something that, I don't want it to be this big doom and gloom of like, we're always no to annuity. Of course,
No.
ideally,
we
would
still fiduciary advisors.
Yes.
In the end, we have to look at how we got here and what is in your best interest. We're not going to just go, we're going to liquidate this annuity and move it on out.
Definitely.
That's usually my intention. But as I get into it, yes, you have to take a look and say, no, actually, you need to keep this. The difference is, let's look back from when they bought it to where we are today. What if they hadn't have bought it? And let's say we put this into even a conservative allocation, they would have so much more money.
Definitely.
But you can't change that.
No, you can't.
You can only look at the current situation. And that's why we do have the annuity rescue program. So we can get people out of annuities into a much, much cheaper version. Still in annuities, still have the tax protection.
Exactly.
But if you have an IRA and you're outside your surrender period, get that thing into an IRA. I'm sorry, if you have a qualified annuity, right? Get that thing out into an IRA.
Yeah.
If you're past your surrender period.
Exactly.
Typically, that's what we're doing. In most cases, we have to wait for surrender periods to expire. And then clients see it, though. They come in, they're like, I don't know if I should have done this. And you start looking at it with them, and it gets down within like, it's a 2% penalty. And they looked at what's happened with the rest of their money. They're like, just get it out. I'll pay the 2%. I want to participate in this over here. This is not doing anything for me.
Yeah.
Because they got sold the annuity. And a lot of them come in and say, I have this annuity. I probably shouldn't have had it. I don't know why I did it. I know why you did it. You got sold. You got sold something. It's
exactly
no different than how did you end up with that car? A lot of times we get sold cars too. And we're like, I don't know. I like it, but
no, it's like, oh, well, if you don't buy this car right now, someone else is going to get it. Someone else is going to get it. I already have someone else that they really want this car, and then it's like, oh, well, I've got to buy it or I'm going to lose it.
They only made one at the manufacturer.
Yeah.
There's not another one in the land.
Nope, not another one out there.
Okay. So if you're going to go talk to your annuity person today and you're like, I listened to this podcast, I have some questions for you. Let's give them some questions they can ask.
Yeah, I think a great one is asking how are they compensated off of the product?
Yep.
And really understanding that. I will say something that I've heard here recently even is there is a commission. They will tell you you're not paying the commission directly. Sure, you're not writing them a check for 5 to 10%, but they are getting paid off of that policy for the time period you have it. So just be really mindful of that. While they may say you're not writing them a check for it, you're not paying them directly, you are paying them because of the reasons we've outlined in the contract.
You're paying somebody.
You're paying somebody somewhere.
I want to know what fees I'm paying to anybody is the question you
exactly.
ask, right?
Exactly.
How are you compensated? First of all, if they say, well, you don't have to pay me. The fund company pays me. And so for some reason in people's head, they go, oh, I don't have to pay for this. Someone else is paying for it.
Yeah.
You're paying.
You're still paying for
yeah,
it.
just like volatility is
Yes.
the price to rate of return.
Mm-hmm.
Locking your money being locked up and your fees that you pay on an
Yes.
annual basis forever in this product is what's
Mm-hmm.
paying that commission indirectly.
Exactly.
I
And
I would say if they say, maybe a more direct question, do you receive a commission for me buying this product? And if the
yeah.
answer is yes, you get up and leave.
Mm-hmm. And really just understanding, what those commissions are as well. And then what are the total internal fees of the policy as well.
Mhm.
So it's really understanding, okay, this product, and like you were just saying, what are all of these fees?
I
And
don't think
exactly
the person selling it to
outline.
you would necessarily know that answer.
Mm-hmm.
I really
Well,
believe that.
yeah. And I think if they can't explain it, then that's another, red flag. I think
Or they won't explain all of them.
they won't. Yes, exactly. It's, oh, well, you see this fee over here, but it's paying for this benefit. Or, it just gets very, murky. And we had somewhere, I think, written on our notes that basically if you can't explain it in 5 minutes, it's a little bit too complicated.
Yeah.
And that's one of those things where if they can't explain to you their fee structure
I'd say in 30 seconds.
yeah, then it's problematic.
Yeah.
And then I think your third question as well is what are the surrender terms? So really understanding
How do you get my money out?
how do I get the money out of here? And, of course, there's going to be typically you can get that, 10% of the account value each year without a penalty.
Right.
But in addition to that, understand, well, what is the surrender? If I needed this entire policy, like all of the funds out of this policy, what does that look like? And typically that year 10 number is going to be 10 to 14%. It's going to be what you're starting at.
Yeah.
So just be really mindful of that. And then the fourth one is what's the projected long-term rate of return expected? So really just understanding, okay, what growth should I be anticipating off of this policy? What should I be seeing off of this? And then really having a breakdown of course, that's going to go into the options that they have for you to invest in, but really understanding, like we were saying, kind of that formula that they're utilizing in order to, make it to where what your returns are. And then I think really just seeing how they answer those questions and if they have the ability to answer those questions.
Watch them squirm. They probably won't squirm at all. These are all really good salespeople. When it comes down to it, they probably could sell a toothpick to people with no teeth, honestly. That's what makes them successful.
Yeah.
Thank you, Michaela. Thanks for listening to today's episode. If you like this podcast, please leave us a review wherever you are listening. Your review means a lot to us. Additionally, if you want to download our free guide, Buyer Beware, Why Do They Keep Trying to Sell You That Annuity, on our website, go to wiserinvestor.com/guides, where you can find it in our show notes. We'll see you guys again next week.
Thanks for listening to a Wiser Retirement podcast. We hope you enjoyed today's episode. Make sure to subscribe wherever you're listening. That way you don't miss any new episodes. We'd also appreciate if you could leave a rating and review. If you have any questions about anything that was discussed today, head to wiserinvestor.com and reach out. This podcast is strictly for informational purposes only and is not to be considered as investment advice or solicitation to buy or sell any financial products, securities, digital assets, or any other investment vehicles, or a basis to make any financial decisions. Wiser Wealth Management Incorporated is a registered investor advisor with the SEC. The host and/or guests may personally own securities, digital assets, or other investment vehicles mentioned on this podcast. Neither the host nor guests of the show are compensated for their participation, and no referral fees are paid to or received by any host or guest for clients, listeners, or similar interests. Investments involve risk, and unless otherwise stated, are not guaranteed. Be sure to first consult with a qualified financial advisor, tax professional, insurance professional, and/or legal professional before implementing any strategy discussed herein. Past performance is not indicative of future performance.